Hi, folks. Today I'm going to talk about how premiums of life insurance linked investment plans can affect your other investments. Firstly, it is important to understand that there are primarily two types of insurance plans. One is known as term life insurance, which is a pure coverage plan. It has relatively lower premiums, gives higher coverage, and if you cancel it, there are no penalties because there's nothing which they really have to pay you back for the insurance that you've taken. It's only coverage. The other type of life insurance plans are those which have investments linked to it. For example, they're called as traditional plans, money back plans, or ULIPs. These typically have a minimum premium paying term of 5 years, but it can go up to any number of years depending on your banker or agent, how much they're able to convince you to take it up for. Now, imagine this scenario. You're doing well in your career, you've got recently married, or you've had a child recently. You're thinking about the future and you want to protect yourself and your family. So, you're thinking about retirement planning or planning for your child's education. When a banker or an agent approaches you, they normally show you these plans which combine both insurance and investment, and it looks like you're getting the best of both worlds. However, insurance linked investment plans typically offer poor coverage for the amount of premium that they're charging you. You're better off taking a pure term life insurance plan. It also has higher charges because there are both insurance linked as well as investment linked management fees which are to be charged. So, usually, a mutual fund expense ratio or the fees that they charge is lesser. Apart from all this, there is a minimum premium paying term. For instance, let's say that you've committed to paying a premium of 2 lakhs on an annual basis. After 2 years, for some reason, you're not able to continue your job. It could be a sabbatical that you've taken, or there's been a job loss. You want to cancel the premium for that year and want to safeguard the money that you hold. However, the insurance companies will penalize you for not paying the premium. They move your funds to something like a suspense account where you'll hardly earn savings bank interest. Even if you surrender it, which in many cases you're not allowed to surrender, but if you surrender it, you will not make the principal that you paid for the first couple of years. You can look at this chart as an example. You can see that in the first year you paid 1 lakh, you're getting only 90,000 or so back as surrender value. Even in the second year and third year, you're not getting back how much you paid. It is only in the fourth year that you make slightly higher than the principal that you invested. So, what would any investor do in this scenario? They would like to continue paying their premium. So, they tend to dip into their fixed deposits, which they've kept for other emergencies, or into equity mutual funds, which they've ideally parked for the long term. Therefore, you can see that having a hefty life insurance premium, which you can't stop paying, can often affect your other investments and your other goals. If you're already in this situation where you have life insurance linked investments and you're paying a high premium for it, I would suggest that you create a separate corpus which can be used in case you face a job loss situation. Let's say, for example, your premium for the year is 1.2 lakhs. This means that you should ideally put away 10,000 per month. Instead, I would suggest put away 20,000 per month. Make a corpus not only for this year's payment but also for next year's payment. It also highlights the importance of having an emergency corpus. An emergency corpus is a basic building block of any financial plan. It is required so that we can tide over any non medical emergencies. And for medical emergencies, we should have the second block, which is a health insurance plan, personal, not corporate. The third is to have a term insurance plan if you have any dependents, so that if you are not around, they can still live a fairly comfortable life. Now, I'm not trying to say that insurance linked plans are completely useless. If you know yourself and you feel that you would want to invest for the long term, but if there is no barrier, you may end up taking this money out on a periodic basis. Or if you've already invested in an equity mutual fund scheme where you're supposed to put away the funds ideally for 5 years or more, but because it's very flexible, you can take out money whenever you want to. You've dipped into it a couple of times. Then use insurance linked investment plans because Here, they create a barrier and incentive for you not to take out the money. It can be somewhat useful in this scenario. However, it is a double edged sword because of the pitfalls I mentioned earlier. So, I hope this helps you in your investment journey. If you have any queries, please do drop a comment or reach out to me on my contact points, and I'll be happy to get back to you. Thanks for watching.